Good morning, everyone. Thank you for joining today's webinar, 5 Must-Haves in Your PBM Contract. I am Denise Giambalvo with the Midwest Business Group on Health. All lines are muted, and we ask you to use the chat function to submit questions. You'll find that to the right on your screen. And I've already sent a message thanking you for joining. You should be seeing a flashing green box at the bottom of your screen if you don't have your chat box open. Last year, the Midwest Health Purchasers Collaborative, a taxable nonprofit entity under MPGH, entered into an agreement with Health Strategy to bring their services to our members through Employer RX Evolution. Health Strategy is the largest conflict-free pharmacy benefits consulting firm in the industry. The vast majority of their clients have over 20,000 lives, and many of their clients have over 100,000 covered lives. Through Employer RX Evolution, we are happy to bring their expertise to our members of all sizes. Chris Crawford is Health Strategy's Chief Growth Officer, and he will be leading today's educational webinar. Chris, please take it from here.
Great, thank you, Denise, and hello, everyone. Thanks for joining us. As Denise said, just a little bit about Health Strategy. We've been the leading pharmacy benefit consultant in the industry for the last decade. So today, our clients represent over $70 billion in annual pharmacy spend. It's very important to us that we are conflict of interest free. So what that means is that we do not take any money from PBMs or anybody in the supply chain. We do not consult to those entities. We work solely on behalf of our employer clients. So as we think about the pharmacy benefit supply chain, everyone on this call knows how confusing it can be. And so the graph to the right just shows the different streams, both of where product goes and then the financial incentives that are also in the system. And the headline here is, it is certainly hard for employers to get transparency in the pharmacy benefit supply chain. And a big reason behind that is because over time we've given PBMs the ability to really influence and control all facets of the pharmacy benefit supply chain. So they dictate which drugs an employer can cover, often receiving rebate payments from drug manufacturers for product placement on formularies. They negotiate the price that pharmacies receive when a prescription is filled. They also then negotiate the price an employer or an employee pays when a prescription is filled, and they negotiate with each party separately, which offers limited transparency into the revenue streams, what a PBM is making, and ultimately into the price that an employer is going to pay. So as we think about this, the core of any pharmacy benefit relationship in your pharmacy spend is the actual contract that you sign with the NPBM. So these contracts are long. There's a lot of details in them, and one misplaced word can have a pretty big impact on the overall effectiveness of your contract. So what we're going to do today is just walk through 5 things that are must-haves from our perspective to have in a PBM contract. So we'll cover objective definitions. We'll cover rebates in a couple of different areas. So one, how to define a rebate, and then also how to ensure that you are receiving all rebates passed through to you as the plan sponsor. We'll talk a little bit about how to have control over the formulary and be able to make drug coverage decisions. And then lastly, we'll talk about the ability to keep your contract competitive through market check and early termination rights. Objective definitions. So this is really critical when you put your contract in place, is that every drug that is dispensed through your plan, we want to make sure that it is covered by an objective definition and a guarantee, so there's no ambiguity in your contract. So what we show here is just an example. So this is when we took over a new client at the top of a generic drug, which is a critical definition to have in your contract. Most employers on this call will have roughly 90% of the prescriptions that members fill are going to be generic drugs. So this is a very critical definition. So up top's an example of something we saw in an existing contract. And you can see that the term generic drug shall mean a multi-source drug, set forth, et cetera, or some other nationally recognized source. But here's the key about the 4th line down. It says, or as reasonably determined by the PBM. So the issue with that is we never want to leave it open to the PBM to get to define how a drug is going to be adjudicated or how it's going to be classified. Not that they always will take advantage of that latitude or the vulnerability in the contract, but they can. And as a plan sponsor and fiduciary, we need to make sure that it is absolutely objective and there is no room for a PBM to make a subjective call on how a drug can be classified, because that could benefit them and ultimately hurt the plan. So what you see at the bottom of this page is a best practice definition, which gets very specific in going through how a drug is going to be classified. So First Data Bank and Metaspan, you'll see those listed here. Those are objective third parties that do go through and classify drugs, and there's specific codes within Metaspan. And so what we're trying to get after here in this definition is for every drug that's filled, you layer in this independent database. So for a Metaspan, there's a code on there. So every drug that comes through, this is the way it's termed in the contract. It's going to be this code G in the Metaspan file. We see it. Here's how that drug, and now we know how it's going to be adjudicated, and there's no gray area at all in the definition. And this is absolutely critical to have, and I can't make this point enough. So often we'll see the definition will mention First Data Bank or Metaspan, but it won't say exactly the codes it's going to use. It'll just make reference to, we will look at sources like that, but then the PBM ultimately has the ability to call a generic drug whatever they want to call it. Next is defining rebates. So obviously this is a big topic. Legislation really has stalled on rebate reform, so rebates appear to be here to stay for the time being. So as long as rebates are here to stay, it's important as a plan sponsor that you do receive all of those different revenue streams back as an offset to your plan expenses. So up top, we have, again, another example from when we took over a new client and their existing PBM contract and what that definition looked like. So here you can see, all rebates received by PBM on behalf of the client, less administrative fees, will be passed on to the client during the life of this agreement. Key here is they're not defining what a rebate is. So in this market, there are many different revenue sources that are flowing back and forth from a manufacturer to a PBM. And so how that is classified in the agreements between the manufacturer and the PBM dictates then what you are going to receive as the plan sponsor. So you want your contract with the PBM to make sure it includes all those different revenue sources so you are able to capture those. So at the bottom, you see the best practice definition here, which talks about all different forms of compensation. So that first line, all payments, discounts, reimbursements, and remuneration collected or received by the PBM. And you can see there's a lot of other details that go along with it. So the key is if it just says rebates, and let's say that a manufacturer is giving money to a PBM for a specific drug, and they're going to give that PBM $50 just to put a number out there. Of that $50 they're giving back to the PBM, they may only classify $25 of that as a rebate. They may take so that remaining $25, they might call that a procurement discount. It might be a placement fee. It might be some other reimbursement. And so if your contract only puts language in place that allows you to collect that 25, which is, as a capitalized term as a rebate, you as a plan sponsor are missing that other $25. We want to make sure you have a broad definition of manufacturer revenue and rebates. So once you've defined manufacturer revenue broadly and you've defined rebates, the other thing is to make sure that you are getting a pass-through of all those dollars to you as the plan sponsor. So step number one, again, make sure it's broadly defined. And then your PBM contract should have minimum rebate guarantees on a per script basis by channel. So they may differ. So if you fill a script and it's a 30-day prescription at retail, so at a Walgreens or a CVS or Walmart, what have you, and a brand name drug is dispensed there might be a rebate there. Might be a different rebate if it's a mail or it's filled through a 90-day, and a different rebate if it's filled through specialty. The key, again, is to make sure that it's a set dollar amount by script at each channel, and you actually have minimum rebate guarantees in your contract. The next step of that is to closely scrutinize any language where it talks about drugs that are excluded from rebate guarantees. So this is definitely part of the fine print when you go through. And so there will be classes of drugs that a PBM will exclude from those rebate guarantees, maybe vaccines or something like that. So it's important to know that when you're trying to calculate the difference between a couple bidders, let's say, or trying to understand the value of the rebates that may come through to you in a contract. So it's not only the per script basis, but it's how many scripts those rebates apply to. So understanding exclusions can be a huge difference when you're evaluating PBMs. Obviously, one who has more exclusions is going to result in less rebate value to the plan than one that limits exclusions. Number 4, the plan sponsor should receive all rebates and manufacturer revenue by the PBM, not just the minimum guaranteed amount. So you think in your contract you want that minimum guarantee, but that should just be a floor that you can use for modeling and setting your premium equivalent rates and everything else. But you want to make sure you're receiving all those dollars that are classified as rebates back to the plan sponsor. And so over time, we tend to see that those could be anywhere from 10 to 15% over performance. I mean, you're going to get 10 or 15% more than what you were just guaranteed in the minimum guarantee. And then lastly, we're seeing this more and more now with consolidation in the industry of PBMs and the large medical carriers coming together. Certainly, be wary of any rebate credits that are being applied to the medical admin fee. So oftentimes we'll see as an incentive to keep that business carved in with a medical carrier, they'll say, well, in lieu of passing on rebates, we're going to provide you a monthly credit off of your medical admin fee. We can often see this where your medical admin fee is free because of those rebates. But just know that's something you definitely want to look at. We always want to get a rebate credit on a per script basis and full pass-through, because that difference between the medical admin credit and what your plan is actually generating in rebates is a large profit center for the insurance carriers, and we're going to see this more and more with industry consolidation. Drug coverage decisions. So we have clear and objective definitions. We understand what a rebate is, and now we want to get in and understand which drugs you should be covering. And so our perspective is that a PBM contract needs to allow the plan sponsor to exclude high-cost drugs where a lower-cost therapeutic equivalent drug exists. So as we talked about in that early diagram on the supply chain, a PBM may be incentivized to include high-cost drugs in their formulary because of a rebate they're receiving. So even if your contract has 100% pass-through of rebates, other contracts, especially in their fully insured business and other places, might not have that same language. So certainly the PBM has an incentive oftentimes to include these high-cost drugs with high rebates on their formulary. We've even seen cases where a PBM will tell you need to include these high rebate drugs on your formulary and make it appear that you're losing money if you take them off because you're losing rebate value. But our point is, we want to look at the net cost. So if there's a $2,500 drug, that if you can fill that for $20 as a generic, even if you're getting a large rebate back, so let's say you're getting a $1,000 rebate, that's still much more expensive on a net cost basis than just excluding that drug entirely and filling the $20 generic. So, and the last piece on this, with so many high-cost drugs coming to market, we also want plan sponsors to have the ability to block new-to-market drugs. So as you think about this from a priority standpoint, the first step is looking at your existing formulary today and having the ability to get rid of these high-cost drugs where a lower cost therapeutic equivalent exists. Health Strategy does this with our independent clinical teams. We have a chief medical officer and a chief pharmacy officer, and we have our list of drugs that we recommend for exclusion that kind of fit into that bucket. So that's one piece. And then the second piece of how you manage this ongoing is before a PBM is able to put a new drug on your formulary, you want that same level of independent clinical review going through to make sure that new drugs aren't coming to market. What we see a lot of times is there's new drugs maybe approved by the FDA, but there's enough evidence out there to necessarily include them on a formulary. Or another one we see are high-cost drugs where a manufacturer will change a release mechanism potentially, or do something else with the formulation, add a combination, and then mark up a pretty high price on it when it's really not adding anything from a therapeutic standpoint. So on the next page here, these are just some examples of the rationale that we work with on clients. And what happens is, as a plan sponsor, we have discussions with your benefits team and your leadership, and we say, here are some classes of drugs, and you set your own coverage philosophy of what you want to cover as a plan sponsor and what you do not. And so if you see here on the left-hand side, some examples. So at the top, you could say, we don't want to cover any drugs that are combination drugs where OTC, which stands for over the counter, where the OTC agents are available as alternatives. So you all have probably heard about the drugs Duexis and Vimovo, which are examples of that. So Duexis is a combination of ibuprofen and Pepcid, where when you put those together, Duexis on your formulary might cost $2,500 or $3,000 with a high rebate. And so some employers will say, nope, those two agents are available on their own, so we don't need to be covering this expensive brand drug combination. Also, you look down, maybe 4 down, high cost release mechanism. Here's another one that a lot of folks see coming through on their claims. So here's an example where, metformin extended release has been around for a long time, costs about $20 for a 30-day supply. The manufacturer came out with a different release mechanism and put a $2,000 price tag on that. So if you don't have an independent clinical team, we'll look at your formula and say, no, we believe the metformin ER, the $20 script is just fine for our members, and we don't think there's any added therapeutic benefit for this $2,000 drug. That's a way really to keep an eye on these things. And then the bottom, cream combos with over-the-counter alternatives, these are the things that get our clinical team really fired up when they look at these things, because you may see things as simple as Vicks Vapor Rub going on something, and all of a sudden now it's a pain patch with a combination, and there's a really high price on that. And the last of our 5 must-haves is to make sure you have market check and early termination rights. So, what we hear often from plan sponsors is changing PBMs is a lot of work. There's integration with your medical vendor, obviously. There's making folks go through refilling their mail scripts and other things like that with formulary disruption. So what we want to do is make sure that you have protection in your contract for multiple years. So we often see PBM contracts be in 3-year terms. But over those 3-year terms, your discount guarantees and your minimum rebate guarantees should really be increasing every year in the contract so that it does remain competitive. Your contract should also allow, and this would be a capitalized term, a market check. And so we want to make sure that your contract does allow for annual market checks. And what that process does is allow an external consultant like Health Strategy or somebody else to take a look at the market and then go back on your behalf to the PBM and say, this is what we believe a competitive view of the market is today for this plan sponsor. Here's where the current contract discount guarantees and rebate guarantees fall short of that. And so we believe that the contract should be changed to get up to market, and that's a market check right, and that allows then you to have your contract remain competitive without necessarily leaving your PBM. The last piece on that, though, even with a 3-year contract term, we still like to have early termination rights, or what we call a termination for convenience clause, in your contract. So if something happens from a service perspective, your PBM gets acquired, you're not happy now with the new service team, they won't move on the market check or whatever it is. We do want to have that ability to terminate so that you aren't locked in for a long period of time in a contract that is no longer competitive, especially as the market is changing and new PBMs are coming to market. So as you think about the process, when we look at this, the first step, and this is part of the process that we're doing with MPGH clients, is really optimizing your contract. So again, you don't have to necessarily move PBMs to do that. You can certainly move PBMs and include others if you want to, but it's really just making sure that we have objective contract terms and definitions, as we talked about earlier. And so that takes away any flexibility and vulnerability that the PBM may have to adjudicate claims or classify claims in a way that is not favorable to the plan sponsor. We also want to make sure we do have flexibility in carve-out rights, which then are implemented at each employer's pace. So if you see that next row of things, we talked a little bit about the drug coverage decision. So that's on custom formulary. In this labor market, we have some employers saying we don't want to take away any drugs, even those high cost ones. We're not ready for that yet. But next year, as budgets change or something, we want to have that flexibility that we can turn on that custom formula or start making those exclusions when the time is right for our company culture. Next is retail network strategy. So a big one is being able to directly contract with retail pharmacies and also being able to contract based on the cost that the pharmacies actually pay for the drug versus the average wholesale price or AWP, which doesn't correlate to the actual cost that pharmacies are paying for drugs, and to be able to steer folks to the lowest cost pharmacies within your network. And then on the right, specialty carve-out, we're certainly seeing this more and more. As we talked a little bit about earlier, a PBM may be incentivized to put a drug on a formulary because of a rebate impact. We also see that coming through on specialty, where a PBM may own their own specialty pharmacy. And so when a member calls for a specialty prescription, you could say that a PBM is incentivized to fill that prescription because they're making money as the specialty pharmacy every time a drug is dispensed. And so what we're seeing oftentimes now is carving away that approval, so that prior authorization process from the PBM, having an independent clinical third party look at those approvals and make decisions on what they believe is in the best interest of the plan and the plan sponsor, not because they want to fill more scripts because they own the pharmacy that's filling those. And the last piece at the bottom, pulling this all together, is to make sure that you have somebody like Health Strategy or another firm providing that independent claims monitoring, performance reporting, and reconciling everything back to that PBM contract. So often we see when we come into a new client, maybe the contract was put in place and then hands off, and they're not really going back and reconciling it every quarter to make sure that what was agreed upon in the contract is actually happening through your plans. And so we oftentimes see a PBM didn't code something right, or the way they're adjudicating a claim doesn't actually match back to the contract, costing plan sponsors quite a bit of money. So we want to make sure that you have an independent source going through and reconciling, auditing, and monitoring all of your claims. So that's all the content we had today. Denise, I think we were going to open it up for questions unless you had any other comments.
Yes, while people put their questions in the chat box, or you can raise your hand. You raise your hand, then we can unmute your line so that you can ask the question. So we can work either way. But while you formulate your questions, I'll make a comment, Chris, on market check, an experience that I had where we ran quarterly checks, and we ended up finding some human error where some benefit design things weren't input correctly, and it impacted the cost of some of the drugs. So I found value in many different ways for having that market check written in, and I also found how it was written made a difference in terms of what you could be looking at over time. And I'm just wondering if you have any comments on that.
No, absolutely. And I think that's a critical point too, is, if in our process, because we are going through and defining all those terms and conditions, and we talked about, how to define a generic drug or brand name drug and those other elements, that is going to be different than the norm of what a standard PBM contract normally has. And so that does require a little bit of work on their part to code their systems differently and how they adjudicate claims. And so there could be no ill intent, to not follow the terms of the contract. It could be just somebody didn't set it up the right way because this contract is different than the norm. And so that's why absolutely we want to be going through and doing that independent claims reconciliation and monitoring on a regular basis so we can catch any of those issues early on and work through the PBM to make sure that claims are adjudicating properly.
Great, thank you. We do have a question here from Brian. He's asking, are more medications being shifted from medical to pharmacy benefit? And if so, how can a plan benefit be harmed by this move?
That's a great question. And then certainly I think it's a fear that many employers have now, again, with the consolidation of the medical carriers and the PBMs. And so we see this especially, on specialty drugs when something is coming through and that drug could be filled in a couple of different places. So it could be administered in a physician's office, or it could actually be picked up at a pharmacy. And so a best practice is to make sure that you have prior authorization of that drug over both medical and pharmacy. So when that drug needs to be filled, if they're in the physician's office, the prior auth is going to click on, and you have one group that's managing that over both to make sure if that drug is administered through the PBM contract, and we know this is going to be the cost, and there's also this rebate, it could be a lower cost overall to the plan, versus oftentimes, especially on the medical side, what we hear is if the drug is dispensed there, there oftentimes isn't visibility to the rebate, and the price might also be higher, and it gets lost a little bit in the medical claim file, as it rolls through on the plan. So that is certainly something that a best practice is to have prior authorization over drugs that can be administered both through the medical and the pharmacy, one single point of prior authorization to make sure the drug is dispensed through the most efficient channel.
Chris, if there's one thing that you would tell employers to be certain they do, what would that one thing be?
It all does start with the contract. And so oftentimes folks will ask, well, how much can I save? What does this look like? And I think the headline would be, look at the contract first and have an independent party review that contract. And so that's also if you are with a consulting firm and that consulting firm also has a coalition contract that they're reselling to you. Many plan sponsors say as a fiduciary, now that that group is a vendor, no longer a consultant. So I still need an outside party to really review this contract to make sure it's operating as it should. So along with the contract, I think, is reviewing that contract first before really looking at what are often called the headline rates, or the rates provided on a spreadsheet that might say, this is the discount guarantee you're going to receive on all generic drugs filled at retail and at some number, or here's the rebate guarantees on a per script basis, and the per script rebate guarantees might be higher in one contract than they are in another, but without actually seeing the contract definition, seeing what is excluded, that higher rebate number may actually be a worse deal because they're excluding a lot of things from that contract. So the headline is, please do not look at the rates on their own without tying it back to the actual definitions that exist in your contract.
Great, thank you. Another question in, do I have to wait until my contract is up for renewal before I have it reviewed?
No, you do not. So great question. You'd certainly want to look at the market check rights and the termination rights in your contract, because those do provide natural opportunities for you to go back and renegotiate with your existing vendor. So the market check right, you should have that in there. That's a great chance to bring in an outside party and have a fresh look on what is market competitive and drive those discussions. So don't have to wait for it. And then certainly sometimes, depending on what the termination clauses are, we've had some clients that they look at that, they're locked into what they believe is a bad deal. They go out to the marketplace and the savings are so great that then they negotiate any termination penalties with the existing PBM. So I think the key is, if you haven't had somebody look at this in a while and an independent third party, we want to make sure that contract is staying up to date and market competitive, because again, the market is changing, and for instance, rebates are going up every single year. So at a minimum, take what your actual rebate value has been and adjust that in your contract and make sure the guarantee is now like what you actually received last year. So you're just increasing your floor, or the minimums you're going to receive.
Great. Any other questions? Not seeing any hands up. Any questions in the chat box? Chris, any closing comments that you'd like to make?
No, just really appreciate everybody's time. And obviously my contact info is on there. We can reach out through Denise as well. So part of what we're doing for MBGH members is, taking a look at existing contracts and trying to help you quantify what opportunity there might be if you're able to go through the PBM optimization, the contract optimization process, either with your incumbent or looking at different vendors. And I think with all the different vendors out there that are coming to the marketplace, it's a pretty exciting time to see some of these different models out there. And we've been surprised, I think, at how well they're working. And we're seeing some of our really large clients take a chance on some of these companies that weren't even in existence 4 years ago. So it's certainly an interesting time in our industry.
It is. There's a lot of new approaches and yeah, some, like you said, interesting time in this industry. We do have another question. What is the difference between a pass-through contract and a rebate at POS?
Very good question. So rebate POS would be where rebate is administered at the point of service. And so we see these programs being very popular if an employer has a large population of folks in high deductible plans where they're paying the full cost of that script until they meet their deductible. So what a point of service program does is actually apply a portion of the rebate to the member at their time of the fill, which is great. How you tie that back is we still then want to do the math on the minimum rebate guarantees in the contract and reconcile back that how a rebate was defined, what that total was, then you add up all of those rebates that were received at the point of service, and that should still then match or exceed the minimum rebate guarantees in the underlying contract. So we definitely want to look at both.
Great. I hear you keep saying the minimum rebate guarantee, and I know you talked about it earlier in your presentation too, but that language is really important. I'm getting that. You're driving that home because there could be more out there, right? So at the bare minimum, this is what I receive.
Exactly. And I think what we've seen in some contracts, so there's new vendors out there that will opine that their only source of revenue is sort of administrative fee, which is, very intriguing, I think, to a lot of employers who say, we want to know exactly what our PBM is making, and we don't want them making any spread or margin on other prescriptions. So that pass-through model has become very popular, and a lot of employers want to look at it. One of the things that we've seen in some pass-through models is they just say, we're going to pass through all rebates to you, but they don't define what the minimum rebate guarantees are. So as your CFO may then come back to you and say, well, how do I know what I'm going to get? What can I actually put in there when I'm running my premium equivalents to say what that number is? And so that's where we've seen most of our clients say, we have to have a floor in there. We have to have a number, a worst case scenario. We can't just say, we're going to take whatever you send us, because, rebates are going to be anywhere from 25 to 30% roughly of your total drug spend. So if you take away all of that guarantee in a new pass-through contract, that just often makes, benefits leaders and CFOs a little bit nervous to say, now I've got a 30% of my spend whole that I have no contractual guarantee to make sure we're going to receive that. And so I do want that written into our contract.
Great. Well, I think this brings us to the end of the program. I don't see any additional questions coming through. So I'd like to thank everyone for joining us today, and particularly thank Chris for providing this information for everyone. If you have any additional questions, you can always reach out to Chris or myself, and we're happy to answer any questions for you.
Great. Thank you, Denise, and thank you, everyone.